All right, everyone. Thank you so much for coming here and joining us at Startup UCLA. My name's Robert Jadon, and I'm the director of the Startup UCLA Accelerator Program. Startup UCLA is a program about connecting UCLA students with the entrepreneurial community, and we also run an accelerator program during the summer. Startup UCLA is brought to you by a couple of sponsors, in particular Lightspeed Ventures, based out of Palo Alto, and also Manat, which is a law firm based down here and has offices around the country. And tonight I'm really excited to welcome Chirag Chotalia from the Pritzker Group Venture Capital. Did I say that correctly?
You did, yeah.
All right, wonderful. Which is actually a group that's been super active around here in town, and we're really excited to have them here. They can do a range of different investments and are bullish here about the LA community. And with that, if we could all welcome Chirag here to Startup UCLA.
Thank you.
Wonderful. So maybe you can tell us just a little bit, about the firm and about yourself. And I mean, that's always kind of a good starting point for everyone.
Yeah, sure. So in terms of the firm, as you alluded to, we're a multi-stage venture firm. And so we invest everywhere from seed, which we define as, $250,000 sort of very small transactions, all the way up through growth. And so we're one of the few firms that has an office or sort of local presence in LA that can write a $50, $75 million check. And the reason that we have that range of flexibility is that unlike traditional venture capital firms that raise money from institutional investors and have fairly specific parameters and constraints, we invest in an evergreen manner, which means that instead of raising funds every 3 or 4 years, we have access to a large balance sheet that we deploy across multiple asset classes, including venture capital, and with the sorts of deals that we're the most excited about, agnostic to stage or agnostic to size, geography, industry sector, et cetera. So in terms of, and why that's the case is we're investing the Pritzker family's balance sheet. So JB and Tony Pritzker, their father started the Hyatt hotels. They were also seed investors in Royal Caribbean, which was a very good seed investment, and have also been involved in a bunch of other industrial and consumer companies over the years, very successful financially. And so we're sort of responsible for investing their balance sheet, which is about a $7 billion balance sheet, into venture capital and into other asset classes.
Mm-hmm. Yeah, and also, the family's great supporters of UCLA on a philanthropic level as well. So I feel very happy about that too. So
that's right. I think Tony's the co-chair of the capital campaign that you guys have going on right now.
There you go. That's right. So
pretty exciting.
Yeah, definitely.
And then we opened the LA. I'll just talk maybe a little bit about our LA presence. So we opened an office here about 3 years ago, and really ramped up in the last year. And the reason that we opened an office here was a couple reasons, 3 reasons really. One, Tony Pritzker, one of the two principals whose capital we invest, has lived in LA for the last 20 years, has lots of deep ties to the community, and so we thought it just logically made sense to open an office here. But even more important than that, I think, is we saw what was a huge entrepreneurial community that we felt was underserved by local capital solutions. If you look at just the entrepreneurial energy in this room, I mean, it's pretty incredible. But if you took all the venture capitalists in LA, you could fit us in a small little corner right over there, right? I mean, we just don't have a deep bench of local investors. And so we saw what was a pretty big mismatch in terms of great talent, but not enough local money. And so wanted to find a way to, solve for that. And another thing that, Tony feels very strongly about is that, we have so much local tech talent here, but I think a lot of, the best talent feels that they have to leave LA when they graduate from places like UCLA because financing isn't available here or talent isn't available here, and so we wanted to find a way to help sort of keep the great talent that LA develops in LA over the long term. And so the approach that we've taken to LA is not sort of a let's do a bunch of deals and sort of see how it works. It's let's take a very long-term approach to helping build the ecosystem, in terms of supporting schools, obviously writing checks into deals, but just helping sort of build the overall ecosystem as it sort of continues to grow.
Mm-hmm. Yeah, and I would say I think, even though I know you already said it, but I'll reiterate, is I do think it's really, really unique, the wide variety in check size that you guys can write. I really think you guys are the only firm in LA that really does that, and just something for people here to know that, you can start off really small and really grow into it with them. And that's just a really great value add to have. So
yeah, it's nice. I mean, we don't have LP constraints. So what happens in traditional venture capital is if you raise a round of financing, let's say X firm leads your A round, you typically have to go out and find another firm to lead the B round because one, firms feel like they hit their sort of requisite ownership percentage. So firms typically target 20% ownership stakes. And once they hit that ownership stake, all they have to do is their pro rata into the next round to maintain their ownership. But they typically don't want to step up and sort of lead the next round. They want somebody else to come in and price it because they already own what they want to own. They might have cross-fund issues. They might not have enough reserves in their funds to continue to write checks. And we're not bound by any of those considerations since we don't have a typical fund structure to invest out of. So there are lots of examples in our portfolio where we were initial seed investors in a company and then we're able to continue to support the company in a pretty material way in their subsequent rounds of financing.
Mm-hmm. And so maybe you can tell everyone also a little background about yourself and sort
Sure.
of how you got into this space.
Yeah, so I was fortunate enough to, I came from not tech background. I graduated from college, went to school out east, worked at McKinsey for a couple of years, did the sort of consulting training program, went into private equity, so much more late stage institutionalized finance. And at some point after doing it for several years was like, this is not exciting to me. I mean, sitting around and debating whether a company is going to grow at 3% a year or 4% a year was not, which is really important in private equity. I mean, you make your returns, on those margins, wasn't sort of that sort of, visionary, changing, part of finance that I wanted to be part of. And so I went to business school. I went to Wharton out east, and debated while I was there. Do I want to build a company and sort of be a founder at a startup, go work for a great founder, or go back into finance but do it much earlier stage? And so I used my time at Wharton to kind of explore all three paths. I tried to start a company that didn't really go anywhere, which I can talk about later. Then worked, decided, okay, well, if I'm not going to be a founder, let me go work for a great founder. And I had the really good fortune of being introduced to Brian Lee here in LA. And I know Brian's come in to talk to this forum before, but Brian obviously started LegalZoom, ShoeDazzle, and then The Honest Company. And so between my first and second year of business school, I interned for Brian. That was my first exposure to both sort of a high-profile consumer startup and also to the LA ecosystem, and loved it. I mean, I had an amazing, incredible experience. And at the end of that, I concluded that sort of wanted to find a way to marry all the work that I'd done in finance prior to going to business school with the experience that I had. Venture capital was one of the best ways to do that, and so here I am.
Yeah. Well, we're happy you're here in LA. So, what? I mean, you're seeing a lot of different things in terms of the landscape, but also because you see different stages, and so. Most of the people we've had come by usually focus more early stage, but maybe you could give us a little bit of the landscape of what's interesting to you right now, any trends you're seeing, in terms of companies or verticals, what's catching your eye?
So a couple of things. One, really, really interested in the power. I mean, and I'm sure that a lot of people have said this to you, but what's incredible is how important mobile is becoming to our day-to-day lives. I'm sure you guys have all read Mary Meeker's, State of the Internet report. Mobile penetration's dramatically increased, and mobile shares, particularly in a vertical like e-commerce, has dramatically increased. So I think overall e-commerce is growing at about 8 or 9% a year. That sort of seems like it's flattened out. So e-commerce was growing at, call it 20, 30%, 7 or 8 years ago. It's now sort of slowed down. I don't think it's going to slow down much further, but call it, 8 to 10% a year growth for the next 3 or 4 years. Mobile commerce, on the other hand, is growing at 25% a year. And I think we're still very much at the early stages of the sort of mobile commerce revolution. Mobile does a lot of interesting things, right? I mean, you can sort of capture, like when I walk around with my iPhone, I'm often taking notes. I'm sort of capturing a lot of intention that I want to transact on, but I don't have the means to transact on it right away. And so I think a lot of people are going to work on and are working on how to solve taking those impulsive instincts that I might have, those sort of, mobile's with me all the time, and so taking all those impulses and intents and figuring out a way to help me transact on those impulses or intents that I might gather throughout the day. So I think just the stuff that's happening in mobile is really interesting. The collision of content and commerce is really interesting. So we just invested, we're investors in Beachmint, which just merged with the Lucky Group. The Lucky Group is out of New York. They run Lucky Magazine, and Beachman's obviously been here in LA, and the two entities just merged. And the notion is that you could take Lucky Magazine, which has historically been a print magazine, Beachman, which has been historically a traditional e-commerce site, marry those two together and create an incredibly powerful shopping experience where you take what's historically been a flat piece of content, make it rich, make it alive, make it shoppable, and that's really interesting. So I think we're still really early in terms of content marrying commerce.
Gotcha. Okay. Yeah. No. I mean, I completely agree, and I think that in a lot of ways that's probably a great fit for LA. And as you mentioned, Bryant has been by here, and so give us a little bit of the story on that. So what have been what are some representative investments from the portfolio so that people can kind of get a flavor for where you guys
So
are
we're
at?
investors in The Honest Company. We're investors in Dollar Shave Club. We're investors in a company called HelloGiggles, which is Zooey Deschanel was the face of the brand, and it's basically this incredible community-driven content site for women. The company reaches 13 or 14 million unique viewers a month, and what it does is, what was really captivating to us is that it's mostly community-driven content, but it's curated. So there's curators. 80% of their content comes from readers, but it's all sort of curated through the team. And it's positive, uplifting content. So when you go online, there's a lot of negative content. There's a lot of internet trolls. There's just a lot of people that'll tell you all the bad stuff that's going on in the world. Not many sites that tell you the good stuff that's going on, but not in a hokey, sort of Oprah way, in a way that doesn't insult your intelligence, that appeals to urban, sophisticated young women. And this was just an incredibly powerful site. So super excited about that one. We just invested in another company also targeting a similar demographic called Women.com. So Women.com came out of Y Combinator, and the founder was the first female employee, one of the most senior female employees at Facebook, and Facebook's first employee in Los Angeles when they opened up an office here 4 years ago. And the notion is that it's it's a new social network. Social networks are really, really hard, really hard to create. But if anyone can, it's somebody that's done it at Facebook before. And it's a gender-gated site, so only women are allowed on the site. And it's a place for women to discuss issues that they only would feel comfortable discussing in a gender-gated way. So it was interesting as an investor, since our team is all male, though we're looking to change that. But none of us were actually allowed access to the site. So it was kind of an interesting one to do diligence on, because we're like, what are we had all of our female friends check it out for us. But none of us, they take gender gating really seriously, and only allow women on the site. But
how do they ensure that? What do they do to? I mean, we always hear that about .edus and things like that. Well, how would they know?
So you have to connect through either Twitter or Facebook, and then they also have a mechanical Turk on the other side. So not only do you connect, and that's sort of the first layer of gender verification, but then the second layer is somebody actually reviewing the profile and quickly saying yes or no.
Yeah.
We've also done a bunch in the MCN space here. So we were investors in Awesomeness TV and in Big Frame. That's another sector that we like a lot and think is one of LA's strong suits. And have also done a couple of enterprise deals here. So enterprise is much smaller than consumer in LA, but there's a lot of it. And so we just invested in a company called Retention Science, which does what we think is best-in-class lifecycle marketing for e-commerce companies.
Right. A Mucker Lab company, right?
A Mucker Lab company, right.
Yeah, okay, great. Wow, so it's
I should mention Vow to Be Chic, which came out of UCLA.
Oh, okay, right, okay, yeah, definitely. All right, well, that's a pretty wide range, and I know, like you said, and that's even not really focusing too much on the enterprise side of things. So, yeah, that's really, really interesting. So, in terms of what you're looking for in entrepreneurs, and we ask this to everybody, what are the things that stand out, and are there any deal breakers for you? So you can start with the fun stuff, and go with that, but and we'll talk about the other part if there's anything that you're like, okay, once you kind of see that, it's just it's a big turnoff for you.
On the consumer side, I really like founders that live the brand. I think that to create an incredibly, especially in e-commerce, right? So and that's a vertical that I spend a lot of time on. It's really, really hard to compete against Amazon eBay and sort of the 800-pound gorillas in e-commerce. And so unless you can create an incredibly compelling brand for the consumer, I think it's really hard to stand out from all the noise in commerce. And so what I look for, in terms of teams are one, on the commerce side specifically, and then I can answer this more broadly, but founders that fit the brand, founders that really understand the brand because they are the consumer for the brand. I think that doesn't always have to be the case, but I think really is helpful. It gives me a lot of confidence in their ability to deliver something that'll stand out from the noise. I'd say founders that appreciate how challenging it is, right? Because these incumbents are large for a reason, and typically as a founder, you're going up against incumbents that are incredibly well-funded, that have strong balance sheets, that can outspend you, have an army of people when you're a founding team of 2 or 3 or 5. They might have a staff of 5,000, and so is this founder somebody that I think can compete and win against those sorts of dynamics? What's their unfair advantage to win? So have they been in the industry for so long that they have a set of relationships that's unique? Do they have they studied the space so incredibly well that they understand all the nuances around the space? Why them as opposed to the 10 other people that have the idea? Because I think the power is very rarely in the idea; it's in the people. And so I'm sure this is sort of, you guys hear this from everyone, but it's just people is so much, to me, ideas are a commodity, people are really what you end up investing in at the end of the day.
Mm-hmm. Mm-hmm. Now, if you were looking back at some of the things that haven't worked out as well, were there any things that you can think about, that, things you're not so fond of, or, things that stand out, or, I don't know, things that just turn you off when you see something in a pitch, you're like, okay, that's just not really what I'm looking for?
I think there are a lot of, not everything has to be a venture business, right? At the end of the day, I think the vast majority of great entrepreneurial businesses in America are not venture-backed. Venture is very specific. It's specific to instances in which you are going to be cash flow negative for a long period of time, so that you need to fund that deficit of cash until you hit break even and then can accelerate your growth. Or, it's in a business model where you're at the cusp of hitting sort of an inflection point. You really need some capital to really accelerate your growth. But those are very unique cases. And so the vast majority of stuff that I see that I don't end up investing in is not because I don't like the team or I don't like the idea. It's just because it doesn't meet the profile of a venture deal, which is what I described, along with venture type scale. And so there are a lot of businesses that will grow to be really great, call it $3, $4, $5, $10 million businesses, but to deliver the kinds of venture returns that we're looking for, given the risk that we take, you're looking for a business that you think will be the next $100 million business. And so, again, at the end of the day, I think the businesses that I described, which are these $5, $10 million businesses, can be really lucrative for the individual entrepreneur, but just don't meet the profile of the risk reward that we're looking for.
And do you tend to see that more? Is that more apparent on the early stage or on the later stage for you, in terms of seeing those types or making that clarification?
Typically on the early stage, because on the late stage it won't get to us unless it's been, typically when we're looking at something that's late stage, it's already been venture funded for a couple rounds, and so they typically already have checked that sort of, we're of that venture, we have that sort of venture business DNA.
Yeah, okay, no, fair enough, that makes sense.
But I just think, I guess to underscore that point, I think there's a lot of pressure for young entrepreneurs to go out and raise venture capital because it's the thing to do. I think most businesses don't need to raise venture capital, right? So I'm actually not selling myself right now. I'm telling, and I think venture capital just meets it's appropriate for such unique businesses that the vast majority of entrepreneurial wealth creation in America doesn't need venture capital to kind of get there.
Mm-hmm. I think that's great. Yeah, I mean, and like you said, there's a lot more of the other opportunities. So, I think that's great advice. A lot of times we get this idea brought up about, the arrogant founder. And, some people love that. They want to see the person who's ready to take on the world and won't take no and won't sell at, 500 million. They won't sell at 5 billion, who knows what. How do you view that type of founder? Is that something you appreciate, or is it case by case?
I think we appreciate, a high degree of self-esteem, but with a willingness to listen and to, be intellectually open. So I think you look for both traits. You look for somebody that obviously has this almost irrational belief that what they're doing is going to, they're going to be able to break down walls and barriers. Because you need, at the end of the day, when it's, when you've been working 18 hours and you're tired and, 99 doors have been slammed in your face, whether it's, you're pitching venture capitalists or you're out there, trying to, do a business development deal and people say no, you want somebody that has that healthy degree of self-confidence where they're able to go on to the next call and the next call and the next call, keep, pounding down the doors until that 100th door opens. But you also look for, people that are intellectually coachable so that, as a VC, when I go to a founder and say, look, I've seen this play out, in these 3 or 4 ways. I think what you're doing is maybe not a great idea. I think you should maybe think about it this way. They're open to having that discussion because I think that's really important. So arrogance typically tends to be a turnoff for us. We think we like that sort of humble self-confidence more than the arrogance.
Okay, yeah, so it has to have a little bit of that coachability and yeah, okay, no, that's totally fair enough. So, okay, in terms of, a couple other sectors, and we've asked this a few times over the summer, but what are your takes right now on Bitcoin and then also on drones, which then we've had a lot of people bring those up to us.
Yeah, interesting. So Bitcoin's frankly not a space that I've spent a ton of time in. I mean, I think that it's interesting. The world's becoming smaller in general, and there's a lot of leakage in, there are a lot of barriers both logistically but also monetarily to creating a smaller, more integrated world. It's really hard to, on the commerce side, ship product from here to a foreign country in an affordable way, or to receive product from a foreign country here. And so part of that leakage is logistical and is really hard to solve. Part of it comes down to currency, right? An exchange and the money that you lose through transaction costs. And I think Bitcoin, to me, at least from wearing my e-commerce hat, is going to be really helpful there at sort of solving a part of the issue through creating a more integrated global sort of e-commerce marketplace. On the drone side, super interesting. I think there's a lot. There's so many applications. I think it's going to be a while until we see Amazon delivering, 3-hour in 3-hour windows using drones. But I also don't think that world is that far away.
Yeah. No, there's been a lot of debate and a lot of controversy, I think, in both of the categories, and I think it's still kind of making its way out into the market, but lots of potential, and we've had a lot of people bring up different concepts to us here, even just on when people pitching into the program, and so it's interesting to see that sort of gain more acceptance, with the entrepreneurs. So
I think on Bitcoin, it's also hard to. So I think the notion that there needs to be a digital cryptocurrency, I absolutely believe in that. Is Bitcoin the right answer? I don't know, but I think there will be at some point. The need really clearly exists. So whether it's Bitcoin or Dogecoin or whatever coin, there will be a coin that at the end of the day, serves a purpose.
Right. Okay. In terms of the LA ecosystem, how much, I wouldn't say how reliant, but there's a number of accelerators now that have popped up. How does that play into your deal flow? And how do you judge companies coming out of those versus ones that are not coming out of them, let's say?
I think we're really agnostic. So, I think it's always really nice to, to see companies that coming out of the accelerators or incubators that we respect. And I think, the 4 or 5 that we have in LA that, are the more prominent ones have all done a really good job of serving the local ecosystem. I think the unfortunate thing on the incubators or accelerators is that there is a power law. So if you just look at the incubators and accelerators that have created the most value, the tail drops off pretty rapidly, right? There's Y Combinator, and then there's Techstars, then there's 500 startups, and then there's kind of everything else. So I think that's the sort of flip side of the incubators and accelerators. I think LA had one too many, and that's already started to wash out. And so now we're sort of, I think, going to get back to an environment where the bar of quality of companies that you see through these programs will be as high as they once were before we had a proliferation.
Gotcha. Yeah.
But from an investment sort of, from an assessment perspective, I don't think we look at companies, any differently that come out of one of these programs versus not.
Okay. And in terms of, let's say, Y Combinator, which had their demo day just a couple weeks ago, what's your take on the valuations that are coming out of those, the companies in that program, in particular?
Yeah, it's nuts. It's totally nuts. I mean, you'll have companies that generate zero revenue today. They were an idea on a piece of paper, 2 months ago, and they have, a $12 million valuation, right? So it's just, some of those are, but I think.
Will you ever not do the deal on valuation? Like, do you ever hit a point and you're like, you know what, I love this, but I just can't do a uncapped, no discount-ish, or maybe a discount with no cap kind of,
Yeah, we
financing?
bump into that all the time in this current environment, and I think every firm is bumping into the valuation sort of as being the constraint on why you wouldn't do a deal.
Okay. And in terms of what you guys are looking for, so that's varied, and a while back it would have been maybe the full business plan might have been thrown over to you, and then maybe it was the PowerPoint. I've even seen companies recently just showing me metrics of what they've done over the last few weeks or month and a half. We've grown every week, we've doubled every week.
Yep.
And you're like, well, can I see the PowerPoint, get the rest of this, where's the business model? And they're like, yeah, no, we're just not doing that. Like,
Yeah.
and I know this sounds crazy. This was 2 companies that were in the last YC batch.
Yeah.
So, what's your take on that? I mean, when you see that, is that, arrogance, or is that, hey, we're just product focused and, we're.
Yeah, that's kind of a
after-
turnoff, to be honest. I mean, when I run into that, it's not an attractive trait, I think.
Okay.
So, I mean, look, if it's Jack Dorsey and it's his next idea, or somebody else iconic in the industry that's created a lot of value, maybe they can get away with doing that, and that's okay because it's Jack Dorsey, or it's Mark Zuckerberg's next venture, or whatever it is. But those cases are very few and far between. So I think we like to sort of, maybe it's a little bit old school, but we like to see sort of diligent, thoughtful business plans and PowerPoints and.
Gotcha. Yeah. Okay. No, understandable. I think I'm in that camp too, so I'm not disagreeing with that at all. But in terms of, let's say, in the financing, we've also seen a trend recently with a lot of convertible notes where the first batch gets like a $5 million cap, and they raise 500 grand at that, and then they want to keep going because there's momentum, and they're like, you know what, we're going to do the next batch at 7 or 10 or whatever. What do you think of that as a fundraising strategy?
Oh, so they close on the first 500, and they say if you're not in.
Right, like they're trying to incentivize people to come in early, and they're saying, okay, we want to give a deal to them, but it's like the other people are investing like at basically the same time. They just weren't there early, and they just say, hey, we already hit our 500, so we're really excited about that because of momentum. We're going to go for $1 million, so the second 500, we're going to put it like a different cap, obviously better for the entrepreneur.
Yeah, better for the entrepreneur. I mean, I think all of these discussions on valuation and sort of structures like that, I mean, at the end of the day, it's whatever the market. I have entrepreneur friends that will come and say, should I do this? Should I not do this? This is the valuation that I'm looking for. Do you think somebody will write a check? And all you need is one person to say yes, right? I mean, and so if you can get away with as little dilution as possible, drive your valuations up. I mean, mathematically, that is a good outcome. The danger in that is that you then set a really high bar for yourself, so that when you want to go out and raise your next round, if you've raised a really high valuation, the investors will ask, right? When you go from your A to your, let's just say, you go from your A round to your B round, if you raised at a 40 pre on your A round, well, the expectation is that you'll at least want to raise at 60 or 70 on your next round. So if you don't have the traction that sort of merits that kind of valuation, that's where you start to get into challenges, and that can be disruptive to your process and or result in a down round, which is not ideal for your existing investors, for you, and so that's the downside to sort of playing the valuation game. But that said, I mean, I think in a market like this where you have a lot of people writing checks that haven't historically written checks, a ton of corporate VCs, a ton of new seed stage investors, if you can raise at a fair valuation or a healthy valuation, and you believe that you'll be able to earn or grow into that valuation, there's not a ton of downside.
Mm-hmm. Great. Okay, well, I'll stop doing all the questions now and open it up to the audience. So does anyone have any questions for Chirag? Yeah.
So you showed some interest in e-commerce as well as some other industries, but what do you think about social media? Like Facebook and Twitter have been around for a while. Recently, they've been figuring out ad revenue, and now Snapchat's on the rise with just potential. Do you think there's space for another successful social media company?
Yeah, I mean, Snapchat didn't exist 2 years ago, right? So I think they've shown evidence of that. I mean, Vine, Whisper, Secret. So I think Secret launched I think less than a year ago, and so and we can all debate kind of the ultimate value of these companies. I think the jury's still out on a lot of those, but yeah, I mean, I think there's incredible innovation and still a ton of room. Women.com is one of our most recent investments, and I think that one's a really interesting take on traditional social networks.
More about that one.
I know, right?
Yeah. So $10 billion Snapchat valuation. You're the CEO. You're Evan. Are you selling at $10 billion, or are you pressing for more?
Yeah, but I would have sold at $3 billion too.
Okay.
So I'm the
all right.
wrong
So
person.
you're already
to,
out. Okay.
I'm the wrong person to ask the question. Yeah.
All right. Hey, fair enough.
Can you tell us a little bit about your first company you tried to start?
Oh yeah. So it was like a beachment model where celebrity-backed e-commerce, but I wanted to do it in India because celebrities. I don't know how many of you are familiar with Bollywood, but Bollywood's the biggest film industry in the world. So Hollywood produces about 300 sort of mainstream films a year, and Bollywood, which is the Indian film industry, produces about 900 a year. And so, the top actors in India are revered like gods. I mean, they have incredible power over the consumer, and so, but have been underutilized for e-commerce and for sort of just general consumer product promotion. And so the idea was going to the top Indian celebrities and marrying sort of their presence with an e-commerce platform. What I learned from that is that I think it's still a good idea. India is just incredibly challenging to do e-commerce in. One, most people don't have credit cards, and so you need to do cash on delivery, which means a delivery person comes to your door and you literally give them cash on the spot for the product that they're buying, and that creates all sorts of issues around leakage and making sure that you actually get the money that you're supposed to get, because people will all take money and run off to their little village and they'll never find them again. And also what's challenging is that the consumer that this product really attracted to, or was attracted by this product, mostly lived in second-tier cities, so not the big cities like Bombay and Delhi, but the next tier down. And so just the logistics and sort of getting product to these consumers was really challenging.
Yeah, and such a gigantic country, like geographically. So I mean, yeah.
And with such terrible road infrastructure.
Right.
Yeah.
Right.
Yeah.
Now for you, because actually even last week we had this discussion. Would you rather see someone start off with Android, or would you rather see them start off on iOS?
Definitely iOS. I think there are very few use cases in which I think Android's a better sort of first platform.
Okay.
I mean, if you look at every metric, right? I mean, people on iOS are more likely to purchase. When they purchase, they buy more. When they buy, they're more likely to repeat. They just generally consume more. They're more educated. They're more urban, which tends to correlate well with all the other stuff that I talked about. I mean, there is no metric on which Android beats iOS, I don't think.
No? Other than total amount of devices,
Other than total.
right? Yeah, okay.
But in the U.S., that's
right,
a
right,
U.S.-centric
right,
approach.
Right,
So
definitely.
globally, the answer is different, but I think in the American market.
Yeah. No, I think 90% of our feedback has been that, but we did have one dissenting opinion. So
Well, I'm curious, what was the opinion?
it was just based on the number of devices and thinking that was going to be the way to go, with Android. But so are you getting the iPhone 6? Are you lining up after this? Are you headed to the store?
I have my spot in line.
All right, yeah, with your iWatch and everything.
right.
Yeah, me too. All right, yeah. Any other questions? Yeah.
So Mike Jones came and spoke to us, and he is not the biggest fan of e-commerce investing, or through the accelerator, because of the high metrics you need to have long-term success. Do you guys have that similar experience, but just really see the value in the turnover of a company being successful, or do you have particular metrics that you guys consistently look for?
Yeah, so we have really consistent metrics that we look for. We basically, given our focus on e-commerce, we've looked at probably every e-commerce company of size and scale in LA, and a lot of the bigger players nationally, and have a really sort of defined set of metrics that we look for. So sort of stuff that you would imagine, like your lifetime value relative to your cost to acquire, repeat rates, cohort analyses, and we dig through a ton of data when we look at e-commerce nowadays.
And you guys share Dollar Shave Club, actually, right?
Right.
So yeah.
Yeah,
so,
we're in Dollar Shave
You
Club,
guys worked
yeah.
on that one, yeah.
Yeah, who just announced their millionth customer today. So
Oh,
Yeah.
all right. Good to know. Did you have a follow-up question then?
Or just, I think you guys are less early stage with e-commerce, right? Because that's something that you do really want to look for metrics before.
yeah, I mean we'll do with some exceptions, we're mostly Series A and beyond, generally and on e-commerce.
Gotcha.
You're in Dollar Shave and a few of the other subscription things. Do you see that as a trend, or do you see that's going to continue on?
So it was a trend because I think a lot of people tried to do it to actually unnaturally enhance their business. I think when subscription makes a lot of sense for disposable products that need to be replenished. And so when you don't artificially create a business model that doesn't meet, I think subscription works when the cadence of consumption matches the business model. And so on Dollar Shave and on Honest, those are both disposable products that get used. There's a regular cadence to that consumption, and so subscription makes a lot of sense. Now in some intangible products, some tangible products where they're not disposables, it feels more like a gimmicky sales model, and therefore we've seen an implosion. We've already seen an implosion in that sector around some of the more gimmicky models. So.
What do you think of smartwatches, the wearables? Do you think they are going to be like the future mobile?
I think they're really interesting. I think the problem is that I think in that space there are a lot of entrants that haven't really defined. When you ask somebody what's the difference between these 4 or 5 options, the option set tends to be pretty similar across sort of form factors. Nobody's really done a good job of selling to the fashion crowd. So I think there are lots of wearables that look very techy, and so all of us in the room, given the fact that we're all in tech, might find them appealing, but the average person that's looking for something that's more normal looking or fashionable might not. And so I think the interesting innovation there is how do you take technology but merge it with a cool form factor that makes it more mainstream and less tech looking. I think that's the issue with Google, one of the issues with Google Glass too, right? Like the chairman of Luxottica, who is partnering with Google on making Google Glass more consumer friendly, has said he wouldn't wear Google Glass in its current formation. So I think things that look really good in San Francisco don't look good to the rest of America, unfortunately.
Right.
So,
Right. Now you don't wear a watch right now, but
I don't, yeah.
Would you think you'd be wearing an iWatch, or you?
maybe, yeah.
Maybe, depending
Consider it,
on.
yeah.
All right.
I use my iPhone for time right
Right.
now. So,
Right.
but, oh.
Okay. Yeah.
Do you? Oh, you don't wear a watch.
I don't either.
No.
Yeah, but I will have
Who
to
wears?
see.
How many people are wearing a watch in the room? I'm curious.
Yeah.
3, 4, 5,
6. Yeah.
6. Wow. I bet 10 years ago that number would have been much higher.
Yeah. Yeah, definitely. Yeah.
Do you have any favorite apps you're using now? Anything that's out there that we should all know?
Let's see. Pull up my phone. So I'll tell you my top 10. So Twitter, LinkedIn, WhatsApp, Hotel Tonight, Uber. Let's see what else. On the e-commerce side, I like Jack Threads. I think it's a really cool looking app. Hinge is a great dating app. Facebook, Tinder, Instagram, Snapchat, Waze.
Yeah.
Oh.
Okay.
That home screen hasn't changed in a while.
Yeah.
No.
Yeah.
What's your take on the education technology?
It's really interesting. I mean, I think we found, education's broke. I think at a high level, as a firm, and it's a sector that one of my colleagues spends a lot more time on. But, we as a firm, we believe education's broken. Technology will be a key enabler to helping solve that. And it's sort of closing that the digital chasm or the educational gap. Figuring out how to make teachers more scalable, empowering teachers who are faced with budget cuts and higher student-to-teacher ratios to do the same job they were able to do under different budgetary environments today. And so we think there are lots of interesting, compelling solutions in the space. It's still really early. I think, and so we feel pretty bullish on the sector. I think the one concern is that it's been notoriously hard to sell to districts. One, they're cash strapped. Two, just the sales cycles are really challenging. And so, finding ways where either you're selling directly to, you create pull from the students or from the parents because something's so compelling, and or it's kind of a no-brainer for a teacher and makes their job easier and doesn't end up costing a lot. I think those are those are the types of characteristics we look for.
Now, when you think of ed tech, do you think of it heavily much more like K through 12?
Yeah, K through 12.
Okay.
Yeah.
Yeah, because I feel like I've seen most of the activity around that space, and like you're saying, like flipping the class and those kinds of things. So.
Yep.
Okay. All right. Fair enough. Yeah.
So my background comes from a lot of content through blogs and online fashion pieces. So the fact that we're kind of moving our company into that's really exciting for me. But there's also this disconnect in the past of a lot of people saying e-commerce is traditionally, get people through the conversion funnel as quick as possible. I think that's changing, and there's metrics that have shown that. But I was just curious to know, where do you see opportunities for bringing content through commerce in a way that's driving people through that conversion funnel?
So I think it has to feel really authentic, right? I mean, I think that what fails is when people are like, I do commerce, and I guess since everyone's doing content, I need to throw a little bit of content in the mix. And I mean, I think consumers see through that. And so creating a content experience where, I guess first you have to decide who you are. Are you a content company that does commerce, or are you a commerce company that does content? I think it's easier to be a content company that does commerce than to be a commerce company that does content, because you're not going to cannibalize your, you can subtly layer in commerce. You're not going to cannibalize your content as long as you do it carefully. I think with commerce, when you try to layer on content and you rely on that as a strategy, consumers start seeing through that. It's just not, I don't feel like it's that compelling. I mean, I think the best examples are things like what Net-a-Porter did with Porter Magazine, what Zalando's doing in France. I think in the US we're still really early. I don't think anyone's doing it Jack Threads, I think, is doing it pretty well on the male side. On the female side, Lucky Beachmint, I'm really optimistic on. It's still really early days. But there are very few examples of people that have started with commerce and been able to layer on content and then create something that feels really authentic easily. So I don't know if that answers your question, but.
Yeah, I mean, it kind of brings up an interesting side note, because I understand the authenticity too, but I know, like Refinery29, I used to work for them, and they did, their content thing, and then they tried to throw this commerce thing, and it didn't work out. But I think it was more so that it was inauthentic to what their whole vision was,
Yep.
less than it was the fact that they were content then commerce. I think it had to do with the inauthentic.
So a good example, like there's a company called Food 52. I don't know if you've come across them. They're in New York, and they create they do beautiful interactive recipes. And so you go on the site, it's just this like incredible UI, incredible UI UX, really rich photography, and it's for food lovers. And so they have a base of about 5 or 6 million, mostly urban, sort of young people, culinary food lover types that want to cook at home. And so they've taken recipes and they've made them interactive, so that you can click on each one of the ingredients that go into the recipe, and then on a side tab you can shop. And that feels to me like it's not an unnatural act. Like you're not trying to sell somebody something. You're just trying to make their life easier because they're already drawn in by the recipe, and now you're just you're like, you probably have these tomatoes and these other 80 ingredients, but this one little ingredient we happen to sell, and so it feels a lot more natural, like the flow of that, than something that sort of goes the other way around. So, yeah.
Yeah, I mean, I think there's like a very interesting intersection there, and I feel like a lot of times people are looking at LA for that, and how we're sort of at the intersection of that in a lot of different ways. And I think, like you said, it's a difficult thing to sort of get the messaging right. And we have a company in LA that did a raise. Was it called Tastemade, I believe?
Yeah.
And
They're another great example, I think. Yeah.
Okay. So, do you like the idea of doing the content play, through YouTube and kind of going that route, and sort of finding that niche? Is that so? Do you like that model, or do you feel like it's a tough one, and pulling off YouTube monetization is difficult, and all of that.
Yeah, I think it's the holy grail, right? I mean, I think it's been really challenging, and I think for every full screen and maker, you've had ones that haven't worked out, and so I think Tastemade, a couple of other MCNs that are really focused around a specific demographic or interest group that's sort of wide enough to create a real viable business is interesting. So I think we saw that at Awesomeness, we saw that at Big Frame, you see that at Maker, Full Screen. Machinima has obviously sort of gone through its cycles, but has a really good core viewer base, as does Tastemade. So I think there's certainly models that work well.
Okay, gotcha. I think we might have time for maybe one more question. Does anyone have one last one? Yep.
What are your thoughts on sports social media or sports just startups in general? Have you ever come across them or anything of that sort?
Yeah, I think LA is another great place for that vertical. So a lot of athletes in particular are starting to invest more heavily in early stage startups. So I just met Kobe Bryant started a fund recently with Jeff Steibel. So Jeff Steibel, has he come into class at all? Or?
No.
So Jeff is this incredible local entrepreneur. He's on his fourth company now. He's had 3 incredibly successful exits. He's doing this company called Dun & Bradstreet Credibility Corporation right now, based out in Malibu. Became friends with Kobe Bryant. They put together a little venture firm, and so they're focused almost exclusively on sports tech. And there's a bunch of other, I think Magic has a venture arm. LA is kind of the meeting space, I think, for people in sports or people in entertainment with people in tech. And so I think a lot of great things are happening in that vertical, in addition to entertainment and others that are, very much, I think, trademarks of the LA ecosystem relative to San Francisco.
Okay. And then in terms of, just kind of wrapping up here, where do you sort of see yourself in 5 years, and where do you see LA in 5 years?
Yeah, I think LA is just at the so what LA needs, I think, is a couple of incredible exits, and we're starting to get there. I mean, I think we've had a couple of call it high 9-figure exits. We've had a couple of billion-dollar exits. I think we need to see a couple more of those, because the way and the reason those things are important, right, is that you need to those things sort of the cycle feeds itself, and it's the reason that Silicon Valley is because they've had this incredibly virtuous cycle of companies that have had really smart people join, early days, do really well economically because their companies exited for big numbers and made them wealthy, that then gave them the ability to either angel invest or start companies, that then successfully exited, that then gave them the ability to angel invest and start companies. And so you need to get that virtuous flywheel going that San Francisco has done really well. And I think we're just at the beginning of that in LA, but I think in the next 3 or 4 years, we're going to, Honest just did a round, right, that was announced at a rumored, call it $1 billion valuation. And so you're starting to see those kinds of events, that were once a year, once every, now they're once every 2 or 3 months. And so I think that's a really encouraging sign. So I think we're still early in LA. I think, the baseball analogy is like it's the 3rd inning in LA right now, I think. Whereas up north, I think, it's sort of playing out, 7th, 8th, who knows where. So really optimistic there. And then, myself, I think, so I just moved to LA about a year ago, and I used to work at a firm up in San Francisco. And so 5 years from now, I'm hoping that I have a great portfolio with a lot of UCLA grads.
You've got Brian Lee, so you've got one. So
that's right.
Okay, yeah.
And Kelsey.
That's right.
Yeah, I think just continuing to kind of support the LA ecosystem and finding great deals and great young entrepreneurs to work with.
Great. All right, Chirag, thanks so much for joining us today, guys.
Thank you.